homes up 64% compared to last year, the number of condos for sale. And if we go back to 2022, condo inventory is up 75%. I mean, that's just an amazing figure. We're just seeing the pile up. And Paul, why is it so bad right now?
Right. The three things that are affecting condos more than single family homes are, you mentioned the first, insurance costs. Now, single family homes are under some pressure there, but here in the urban core of Honolulu, it's the high-rise condo, the AOAO, coverage issues, the vintage problem. Most of the condos in Honolulu are relatively seasoned, shall we say. 80% of the high rises in Honolulu were built by 1981. Think about that for a second.
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Welcome to the Hawaii Housing Report. Home prices chart a whole new course. Condo inventory is piling up, and perhaps for the first time in Hawaii's history, in the home market, we have a seller's market, and on the condo side, it's a buyer's market. Plus, the Fed cuts rate for the first time since 2020. Help us unpack it all. Principal at TZ Economics and Hawaii's most woke economist, Mr. Paul Brewbaker. Paul, it's great to see you again.
Aloha, Patrick.
Good to have you here. Good to have you back. I'm Patrick ONeill, principal broker owner at Luxury Homes International. And Paul, there's so much kind of exciting news to get to, but let's start with home prices. And let's start with the median price. This is last month's, obviously, year to date, August. And we can see not a lot of movement in the home prices, but still up about 5% compared to 2022 flat. When we look at the condo side, it's been flat the last 2 years, really not much movement at all. If we go back to pre-pandemic, 2019, we can see home prices are up 40%, while condo prices are only up half that, 20%. We talked earlier, you mentioned that home prices have charted a new course. Can you explain what is happening?
So what we've been watching, as you say, low rates of price appreciation. Although, as it turns out, it's a little more nuanced than that because we did have that overshoot in the single family space, after pandemic onset. So we had a what some people thought was kind of a bubblicious um, surge in single family home prices. You can see it here now, but not in condos. And that's that's the first time, I think, in the Honolulu Board of Realtors data set, which goes back to 1987, that we see this weird separation. You can see, as you mentioned, the condo prices have been kind of flat. They've been drifting from at or above a nice 5% appreciation trend in the 20 teens. They've been drifting a little more sideways the last couple of years, and that's that 0%, year to date that you saw in your compilation. Whereas on the single family side, even though prices are kind of flat to 2022, you can see what I'm talking about there. The overshoot, which some people associate with the move to remote work and an increase in the demand for suburban and exurban detached dwellings relative to condos as a shift in housing preference. But then more recently, and this is the part that's nuanced, establishment in the single family median home price seasonally adjusted arena of the 4% price appreciation that single family homes experienced in the 20 teens. It's as if they've been shifted up. It's like God gave single family homeowners on Oahu a windfall of, I don't know, 50,000 bucks or something. And now they're on a parallel track with the bonus, with the remote work bonus, whereas condos are kind of drifting for reasons that are probably idiosyncratic to the condo space. And so we need to
Yeah.
focus our attention separately on these two different domains.
Yes. Oh, very interesting. And long-term trend line for condo and single family home generally around 4.5%. Is that
Yeah, I
correct?
mean, averaging the two, 4 to 5% is a good historic range, which if you subtract 2 or 2.5% inflation is around 2 or 2.5% real inflation adjusted home price appreciation. And we see that in data going back 60 years.
Right. And we'll talk in a minute about what's creating that bottleneck and that pileup of inventory on the condo market. And I know
Mhm.
there's three specific things we're going to talk about. All right. Well, let's shift over to the Fed, the big Fed news, cut of 50 basis points. What does it mean to you, and what do you think we'll see going forward this year?
Well, of course, the Fed's been waiting for disinflation, for a decrease inflation to be confirmed. And that's finally fallen into place just at a point where now the concern is shifting over to the idea that maybe labor markets are going to soften a little and the Fed doesn't want to go too far down that road. Hawaii, by the way, had a weird surge in inflation earlier this year that was mostly associated with the rent that FEMA's paying over on Maui for displaced wildfire victims. No change in Maui's housing stock, but an increase in rental costs shows up in the consumer price index. But to your point, the Fed did reach a moment earlier this week. On Wednesday, it announced a big 0.5 percentage point, 50 basis point reduction in the overnight rate target and projections for the next several years, which are familiar from recent projections over the last year to 18 months. The Fed has always expected that it would reach this point where it could begin to reverse the increase in overnight interest rates that was designed to tamp down the post pandemic inflation surge. But what was new this week is that we saw the curvature change. Before, the curvature looked kind of like this, a gradual decline in interest rates. This week, they went in a big 50 basis point move instead of 25, a big, like taking off on a triple black diamond ski run, uh, pushing out faster and more, and moving the rate decreases sooner. That is where we'll end up over the next, at the end of this year and the end of
Yeah.
next year. 4.875 sort of is the middle of the target range, going to maybe 4.3, 4.4, 4.5 by the end of this year, maybe 3.5 by the end of next year. That's that's what they're thinking, and that's what the markets are thinking now.
Okay. All right, great. Well, let's relate this all to what we're most interested in, which is mortgage interest rates. And let's bring in Anders
Hello.
Hostelley, State
Hey
Manager
guys.
for Rate Mortgage. Anders, good to see you.
Hello.
Hello, hello.
Keep being here.
Yeah, so finally, some good news, right? After years of waiting, we're
Okay.
starting to see
Years
movement in
of
there.
bad predictions. I mean, we're finally kind of what we kind of talked about. We've been talking about for almost 2 years now, where we really want to see rates, come down from the sevens, mortgage rates, right, for
Yes.
to the, maybe the high fives. Well, we're there now.
Oh, that is
We
really
are
good to hear.
there. We are
And
here. Yeah.
so let's start with that then. Give
Mhm.
us what's the vanilla 30-year fixed rate as
Yeah.
of today?
Yeah, we're looking about 5.875 with about a point. Of course, it depends on the scenario, somebody's down payment, credit score, loan amount, and all that. But yeah,
Yes,
it's definitely gotten a lot better because remember it was the last October when rates were in the mid high sevens.
right. And
Right.
a month ago it was in the high sixes.
Yeah, yeah. So it's really come down. What's interesting is that as rates were coming down, there was anticipation. I mean, the markets knew that the Fed was going to drop rates, but was going to be a quarter, half a percent. So rates came down, and then when the Fed made the announcement, the mortgages actually went up a little bit, just a teeny bit. Um, so everything was pretty much baked in. It was already anticipated. So we had a couple borrowers. I had one come to me and say, "Hey, Anders, I know I locked in last week, but now that the Fed's dropped rates, can I renegotiate and get a lower rate?" I'm like, you know what? Actually, the rate was lower last week, a little bit.
Yeah.
So you had a really good
Interesting because
chance.
the
Yeah.
market had already priced it in when the
Yep.
Fed announced that it
Mhm.
had no change really, right? You
Exactly.
rode through that. But so at you said 5.85, just general, just for a
Yep.
vanilla loan right now. What
Uh-huh.
about a VA loan? What does that look like?
So for a veteran, VA loan or active duty, somebody in the military, the rate is we've even seen it's like 4.875 with 1 point. I was
About
looking
that.
at a scenario, yeah, and many times a VA borrower that they'll because they can finance 100%, they tend to not want to pay as many points, or they may not have that VA loan for as long, so it may not even be worth paying points. Even if you're looking at a 0 point VA loan, it's in the low fives right now.
I
So
see. Oh, that's really good to hear.
yeah.
And what
Mhm.
about jumbo rates?
Jumbo rates are still, they kind of hover about close to about a 0.5% above conforming. So you're looking in the low sixes right now with that same like 1 point.
Okay.
So yeah.
Okay. All right. And Anders, I know that you track loan originations, also rate lock-ins. What are you seeing? Are you seeing any change, any increase?
You know what's
Um,
interesting? Yeah, the purchase market seems to still be kind of, you can see it from the stats, right? We're looking at this, the kind of the stats. It seems to be pretty steady. It's not like there was all of a sudden this, last month a big uptick in purchase transactions, but we're starting to get people refinancing, which we hadn't
okay.
seen in a long time. So we're getting more applications, but refinance transactions. So it's a little bit busier on our
Okay.
side, but not that much.
And when we talk about a normalized rate, I think in the past you've said around 5.5. That's sort of a normalized rate. Is that sort of the target still?
Yeah, I think low fives. I mean, around five-ish, maybe even a little bit. Where that VA rate is. If we can get to the conforming rate to be around 4.875 with a point or 5.25, to me
Yes.
that's sort of a sweet spot. Mhm.
Okay.
Yeah.
And you and I did a webinar last month with Sue Savio, the insurance guru
Mhm.
for the state of Hawaii. And if
Right.
anyone missed it, go check it out. If you're a realtor or a buyer or a seller, you need to watch it. You need to know what's happening. And I'll leave a link to that in our description below. Anders, can you just touch on quickly the issue in case someone doesn't know what we're talking
Right.
about, the insurance issue and how it's affecting the condo financing?
So Fannie Mae, Freddie Mac, which most all banks they kind of base their guidelines on, require 100% coverage for wind, hurricane, fire. And what's happened is because of these global events, these weather events, and how it's affected the insurance industry. There's insurers or big insurers in Hawaii that have limited how much they will cover as far as hurricane insurance. I mean, this is sort of a first. So let's say a building is worth 100 million. All of a sudden you're seeing, well, there's this sublimit of 10, 15, or 25 million. So it's not 100% coverage. So, the local banks are like, well, we can't lend on that because that's not 100% coverage. Fannie Mae, Freddie Mac, it's not eligible. So what happens, we do or have found a few lenders that are non-QM out of the box lenders that will finance in these condos, but they'll look a little bit more deeply at the condo, the reserves, and then the pricing is quite a bit higher than a conforming loan.
Yeah. I think
Yeah.
you looked at one for us maybe a week ago or so, and
Mhm.
it was more than a percentage rate higher.
Yes. Yeah.
And I think the LTVs had to be higher. So yeah, it's a big,
Yep.
big, big issue. And
Yeah.
again, if anyone is not familiar with it and you are involved in real estate, you need to know, you need to educate yourself. Make sure you watch that webinar or something like it. Okay, Anders, we haven't done this for a while because we were
Mhm.
wrong so much. We're going to
Yep.
do the speed round. We're bringing the speed
Right.
round
Right.
back.
Sure. Sure. Okay. I'm
Double
ready.
double points here. Okay,
Okay.
first one, higher, lower, about the same. The interest rate, 30-year interest rate, December of this year.
Lower.
Okay. All right.
Mhm.
1 year from now, higher, lower, about the same.
Uh, I, from today, it'll be lower. Yep.
Yes,
Yep.
it'll
Mhm.
be lower. Okay. And then your final, this is your bonus question.
Okay.
What's it gonna be December of this year? 30-year. We won't hold you to it.
Let's say 5.65.
5.65. All right. Okay. We'll get
Right.
back to you and let you know if those were the right answers. So,
I want to get
Anders,
I want to be right once in a while.
eventually it'll all come around. So, Anders, thank you very much. It's always a pleasure to see you. We're going to take a quick break, come right back with
Thank you.
Hawaii's favorite economist, Paul Brewbaker, and look at the housing stats. Okay, and we're back at the Hawaii Housing Report with economist Paul Brewbaker. Paul, it's always good to have Anders on here, what the rates actually are, what's happening in the streets. Anything you want to add to that conversation?
Thank goodness they're finally falling, and they're falling pretty fast since mid-year. So obviously the market's expecting what the Fed was going to do to validate all of our expectations. However long we've been hanging, twisting in the wind, waiting for those rates to actually come down. We're there now, and there are two components of the decline. So in this graphic, you see measured on the rise scale, the 30-year fixed rate mortgage average, which is down around, I want to say 620 at this point. I think we saw on a slide a second ago. And then the 10-year Treasury note yield as a benchmark, and it's down around 360. So 620, 360, that's 160 basis point spread, if I did the math correctly. Remember that this spread, or this risk premium post-pandemic, had widened out, measured on the right scale here, had widened out substantially to 300 basis points. It's come in under 250 basis points. And it's the combination of the lower benchmark as well as the diminution of the call premium, or the risk premium, as you might label it. Both those factors are helping those mortgage rates to come down. And therefore, as mortgage rates come down, or in this graphic, up, I've inverted the mortgage rates. As mortgage rates go down, which is up, then home sales will go up, which is also up, because the home sales for Oahu are on the right scale. The mortgage rates are on the left scale. So Anders thinks, maybe we'll get into the fives in the course of next year, a mortgage rate with a 5% handle. And I'm thinking, maybe in a couple of years we might break into the high fours if we're lucky. The point is that sales should be able to recover nicely over the next 18 to 24 months. I'd be anticipating it, and both sellers, who many of whom have been trapped, so to speak, with low rate mortgages, feeling comfortable about re-entering the market to harvest some capital gains, and yet not to have to reprice it so much higher an interest
Right.
rate that they're
And okay.
calculating.
Well, the good news is we're seeing that
It's
spread
shrinking.
decrease
Yes.
while rates are coming down. So
While
that's going
rates,
to help
absolutely.
accelerate things just quite a bit. Okay, let's take a look at the closed sales again. This is for Honolulu from the Honolulu Board of Realtors. Homes, yes.
Year-to-date sales volumes.
Excuse me.
Yep.
This is the year-to-date closed sales volume. Single family homes, we can see an increase from last year, up 7.5, while condos are heading down. We're going to talk about that in a moment. If we go back to 2022, we can see both categories are down. Homes 27%, condos by 36. And if we go back to pre-pandemic, we're starting to get back. I mean, we're only 22% down for pre-pandemic, the amount of sales taking place, and condos down 16%. We can see this, yeah. And so let's take a look. This is really, I think, one of the big stories. This is the active inventory. We look at single family homes, it's up 5% from last month. It's flat for condos. We go back to 2023, up 27% for homes, up 64% compared to last year, the number of condos for sale. And if we go back to 2022, condo inventory is up 75%. I mean, that's just an amazing figure. We're just seeing the pile up. And Paul, we had talked earlier about this. Why is it so bad right now?
Right. The three things that are affecting condos more than single family homes are, you mentioned the first, insurance costs. Now, single family homes are under some pressure there, but here in the urban core of Honolulu, it's the high-rise condo, the AOAO, coverage issues, the vintage problem. Most of the condos in Honolulu are relatively seasoned, shall we say. 80% of the high rises in Honolulu were built by 1981. Think about that for a second. So all this panoply of insurance issues, the risks are higher. The insurance industry went through a tough period in the 20 teens when rates were low. They rely on low interest rates. They rely on interest rates for the earnings, right? The insurance companies rely on interest earnings to generate the cash flow to do the payouts for catastrophic events. And
Yeah.
what happened rates were low for a long time, and then a bunch of catastrophes happened and kind of blew them up. And now they're having to reprice not just for the catastrophes, but for the
Yep.
fact that the high rate period wasn't around for
So we've
long
got
enough.
we've got insurance. The insurance issue is a
Yeah. The other
problem.
two
We've got
issues
old
are
buildings. Hmm.
basically the tourists really haven't come back in as great numbers. They're still kind of in a holding pattern. The tourism volumes in terms of visitor days or visitor arrivals have not returned to the pre-pandemic trajectory. It's the path that matters. So a lot of people say, well, they're back to 2019. Yeah, but a lot of investors thought we were going to be at a higher point. And so they may be wanting to exit. And then in addition to that, that's sort of the demand for short-term rentals, let's say, the
Yes.
supply is being impaired by a hostile public policy environment where county jurisdictions are contemplating eliminating short-term rentals or severely restricting the ability to operate short-term rental in this space. So
Yeah.
tourism, insurance, that's a big factor for condos, not so
Mhm.
much for single-family homes.
Hi, this is Patrick. If you're enjoying this information, please consider giving us a thumbs up below and be sure to subscribe so you don't miss next month's housing report. Right. And again, if you haven't seen it, if you're watching this video now, check out the Sue Savio video because the information is incredible and you need to know it if you're a buyer, seller, or a realtor. And just to round this off, if we look pre-pandemic active inventory, there are 50% less homes on the market right now. Certainly that's a driver on the pricing. Condos, not so much. It's still down 23%, but we see that disparity right there.
Yeah, Patrick, if I could show let me displace your slide with mine. I think we can do that. This pattern that we were just looking at in terms of the last few months. So this line right here is where the state legislature convenes and Senate Bill 2919, which enhances the authority of county governments to extinguish short-term rentals. The moment that bill began to be heard, this inventory pileup in condos began. And so hence the big question mark, are they going to be allowed to exist in the future, short-term rentals or vacation rentals? And all of that political, just separate from the insurance problems, all of that political burden or risk is being borne on the condo side of the market, these condo inventories over here, not so much on the single family side where things are relatively stable. And we saw a preview of this in 2019 when the Honolulu City Council passed Bill 19, a bill designed to increase regulation of vacation rentals and a split in the pre-pandemic and then post-pandemic performance once tourism dropped. So there are serious factors at work making on the margin where condos are over in that short-term rental space, making the risk environment more disadvantageous for the prospective
Yeah.
investor.
And it's unfortunate, the political environment. It's so short-sighted. It's such a populist ideal to promote, but unfortunately, it's going to have long-term consequences on the economy.
Sure. I mean, obviously, we're not here to talk about the politics of that, but it's a thing, and it's not just insurance, and that's a thing too.
Yeah, yeah, well said. Okay. Now, I had mentioned at the start of this, this may be the first time that I can think of where we have a seller's market on one side and a buyer's market on the other. And I want to pull up the data to take a look at this. When we look at months of remaining inventory, and just to refresh everybody's memory, generally equilibrium between a buyer and a seller's market, we talk right around 4.5%, something like that. Anything higher than that would be considered a buyer's market. Anything lower would be a seller's market. So this is supply and demand comes out in one number. So I thought we'd start back in 2019 and see where we were. We can see single family homes at 3.6, condos at 4, little towards the seller's market, but not too extreme. Then we head into the frenzy buying of 2021 into 2022, and now we're down into the 1.7, 1.8, clearly a seller's market in 2022 for both products.
That's the
And
last of the low interest rate opportunity, by the way.
Yeah, and then now we can start to see a little, change. 2023 homes at 2.7, condos at 2.8. They're tracking together as they normally have in the past. And now we hit 2024 for the reasons we just talked about. Clearly this big split, right?
Divergence, divergence, divergence.
Danger, Will Robinson. The 5.1 on the condo side, clearly a buyer's market and trending that way. I think it's probably going to go up next month. Homes at 3.4, still a seller's market for all the reasons that we looked at. Do you see any change in this, or they were going to see more condo pile up and homes just sort of continue on their new path?
With rates declining, it might, be a little bit more helpful. With mortgage rates declining, it might be a little bit more helpful for the condos that have been subjected to these specific factors that aren't as influential in single family outcomes. But I definitely expect the single family market to stay, the inventory to sales ratio, basically months of inventory remaining, to stay relatively stable, because low mortgage rates will bring new buyers as well as new sellers
Yeah,
in
yeah,
both spaces. The problems that are idiosyncratic to condos, or that are bigger negative factors for investors in condos, like insurance and the short-term rental
right.
debate, those will
Yes.
continue to weigh heavily in that segment.
Yeah, yeah. Okay, well said. All right, Paul, we haven't done this for a while either, but we're going to go to the lightning round.
Oh
Double
yeah.
bonus points. All right. Okay, we're going to see how you do. Okay.
Forget I said that. No.
Okay. In
You will
December of
not
this
remember
year.
anything I said a year ago.
These are not the drones you're looking for.
These are not the
Okay.
drones.
Home prices in December of this year. Home prices, single family home prices, higher, lower, about the same.
Higher for single family, about the same for condos. I'm going to just guess it's a few months from now. It probably won't change much.
Okay. All right. Okay. That makes sense. All right. What do you think
Opportunity for buyers, maybe, if you
yes.
can get insurance and if you're not a short-term rental.
Yep. Yep. Do your due diligence, because there's
There you
been
go.
some pretty shocking maintenance fee increases in some of these
Yes,
buildings.
right.
Okay. How about the 30-year mortgage rate in December of this year? If we're saying right now it's at 5.8, where do you think we'll be in December?
Low fives, but I actually think down the road, maybe you were going to ask this question, we have a shot at slipping under five, a smidge. Going out a year and a half, let's say. I think that the equilibrium is right in the neighborhood of five, but that's a plus or minus. So the sooner we get there, the better, as far as I'm concerned.
Okay. All right. And if you're watching this video, enjoying the information, please consider giving Paul a thumbs up down below and subscribing so you don't miss next month's Hawaii housing report. Paul, it's always a pleasure. Thank you for your time. I can't wait till next month.
Thank you, Patrick. Yeah, good fun. And it's been a couple months, so this is fun to catch up.
Yeah. And by the way, the event at Oahu Country Club, the mid-year real estate review, which was our 15th year we've done that together.
Yeah,
Big success. Really enjoyed it up there. As usual, you knocked the crowd out and and kept
didn't get
your
in too much trouble.
a little bit,
I've been doing
maybe.
all summer.
Maybe a little bit. So thank you to Anders Hostelley at Rate Mortgage and for everybody else. So until next time, be well, be kind, and aloha.
Aloha.